All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. Market been ticking around here today near the highs of the day. You'll notice the range on the market since it opened is 2707 up to 2732. That is a 25-point range since the open. You say, well, Jeff, what's the big deal? Well, that's the tightest range that we have seen in weeks here from from open to or high low on the day. It has been by far the tightest range. And okay, what's the significance? You start looking at bullish factors. When you start to see the ranges come down, that starts to be more and more bullish overall, and we're seeing that here as well. So we've seen a lot of different components. We've spoken to them. I know small caps are lagging today. Great, they led yesterday. I'm not going to read a whole lot into one day's performance. Tech lagged yesterday. It's leading today. Okay, but overall, when we start to look at how some of this rally is happening. This is a very different style rally to the other rallies that we have seen during this market dip. And that is very clear. It's very evident across the board. It doesn't mean everything's just going to go up or, things are going to, rocket ship and, Verizon, what's going on? It's dropping today. What does that mean? No, there's differentiation out there. There's more of a bullish mechanic to the market that is coming in. Now, we aren't done with the sell. Sells are going to still happen. We're still going to see those. But it is one of those where I do think we've seen the lows, and I think we will see some, some nice kind of, on those sell-offs, some nice kind of higher lows built in here overall. When we look at, some of the different plays out there and whatnot, I'll go through some of the Katie signals and the market vibe here shortly. But I wanted to jump on and do a little bit of follow-up to what we talked about this morning. And this morning we talked about some of these kind of high flyers, some of these, the market's not really positioned to expect it, so how's it going to play out? What's going to happen? Are there some opportunities to maybe take advantage of some of the disruption here overall? Okay, and talked about different plays, AMD, Triple D, YY, the VIX, and those types of things. I thought, let's go do a little bit of an exercise here. I'm going to take $3,000, okay? Now, I am doing this on paper, okay, because I'm not, this is a training exercise. This isn't part of the challenge that's live traded and everything else. Just doing this on paper, but I want to do this as an exercise. I'm going to put $3,000 into these high risk, high reward plays in total. And, we'll go back and look at them in 2 months and assess them and say, okay, you know what? What's going on here? What's happening here? And, do we get some of that action? So I'll show you the plays that, I think are compelling here for that. And let's go take a look. First play that I think is compelling, XLU. Utilities, down. Utility puts. And I think this is a very interesting setup. I think this is one that even has some pricing that's, okay. It's not the best pricing. I will admit it's not the greatest pricing. But when we look at the XLU, when we look at the utility sector, this is something where the 200-day moving average is down here to around 50, right? And I go, okay, 50. Are we going to get down that far? I don't expect we'll get that far, but 51, 52, 51, 52, let me draw that here on the chart. 51 is the, about the 200-day moving average. 52 is right here. So I'm going to go in and put some of this 3K into the 51, 52 put spread. So let's see, 51, 52, and I'm going to kind of take this at what a filled price, a live filled price would be. And so we marked the 51s at 66 and the 52s at 91. So we're talking, what, 25 cents there. So they'll probably fill us at 26 cents here overall. So let's go and grab 30 of these. Well, let's go grab 25 of these at 26 cents. Okay, at 26 cents on the XLU 51.52 put spread. Okay, if you're unfamiliar with a put spread, basically all you're doing is you're buying the 53 put spread here and selling the 52 put spread here. And that's all you're doing. Okay, and basically you're betting on it going down. The max you can have this trade worth is a total of $1. So I'm putting in 26 cents to potentially make a dollar here, and just for context sake, putting 25 contracts here. Now I'm not going to count commissions here. I know commissions matter. They count. You can count those how you'd like there with them, but everybody's different when it comes to commissions of what they pay and what they don't pay. So not going to put that in here. But essentially we're doing 25 contracts at 0.26. So we're putting 25 times 0.26. So we're putting $650 of the $3,000 into the XLU. All right. So $650. All right, I'm going to write this up. I'll throw it on the message feed so you can see it. But there, in on the XLU. Let's go do another. We talked about YY this morning, right? The thing nobody expects is China. China, to do great, grand, wonderful things, to China. Never going to have any trade war resolution. It just isn't going to happen, right? That's the story. Sure, we're probably going to have more tariffs in December, and you know what? They're probably right. But I'm going to go out and take a look at YY. Now, YY has earnings here in about 2 weeks. So the options aren't great. They're not stellar here, but they're not horrid, right? They're not horrid. And those XLUs were the January monthlies. Okay, those were the January monthlies. Sorry about that. So let's go take a look at YY. Take a look at January. Look at the options here. Spreads we know are fairly elevated. Okay, 65. What if we bought a 65 and sold a 75? What would that cost us? That would cost us about $350, right? We have about 3-to-1 risk reward there. That's how I would trade a normal type of call spread if I were bullish. But here we're going to be a little more than bullish, right? We're looking for something unusual, something abnormal, and something unexpected, to come and take place here. And if that does, we want to get paid here nicely for it. So let's take a look at these 75.80s, right? And the mark on these here is about what, $2.90, $2.95, and about $1.90. Okay, so about $1.05 is probably what I would put in as a bid for it. I'm going to mark it here as $1.10, as that's probably a realistic fill. But YY, I'm going to buy the 75.80 call spread for January for $1.10, right? For $1.10, and let's do lucky number 7 contracts here. Okay, we'll do 7 contracts, and so what 7 contracts here is $770, right? And again, if you missed the first part of this video, these are paper trades, but we're just taking $3,000 and we're putting it into some of these kind of high risk but very high reward propositions, things that maybe the market isn't expecting, and if we get a big push one way or the other, they will settle out and pay out overall. Okay, let's go take a look at Tree. Right, here's Tree. And this one here, I'm not going to do via paper trade because you can see the spreads on it. They're monster spreads here. I can't even estimate what would be a realistic fill. So I would have to live fill this, and I'm not ready to just yet. I still think I might get a little bit better price. I'm not ready to bid it yet. So it's one that, when I go and get in, or if I go and get in, I will, I'll do on video. I'll show you. But, it's one that I'm going to avoid here just yet. Okay. Let's go take a look at the VXX. Now, we talked with the VXX. We're not going to get as good of return here, right, on the VXX because it's always going to price in some movement here to the downside. And so the return on this is just a little less. In fact, if we look at the VXX 33.32 put spread here, it's going for, just under 50 cents to make $1. It's kind of 2 for 1. It just is a terrible price. I mean, it's not like our reward is anything if it gets there, right? But if we start to get a little further out, if we start to get a little further down with the VXX and we start to get below 30, let's go take a look at some of those prices, right? We're still in the month of January. We start to look here at 30. We can do the 29.30s here for about 35 cents. That's kind of 35 cents to make $1. That's still not all that good, is it? Right? I mean, that still is kind of, for needing that much of a move. That's just pretty. It's just a pretty bad price, right? Let's go take a look at the VIX. If we come into January, I mentioned that we're kind of pricing these around 17, right? If you look at the 23s, they're going for about $5, $5.50. You look at the 22s, they're going for about $4.50. So about 17.5 is about what they're pricing the VIX out here for January, right? So let's see. Can we maybe take advantage here and maybe expect a move back to 12? What happens, can we get paid if it moves back to 12? Well, if we buy the 17s, we can get those for $1.30? $1.30? If it moves back to 12, those are worth $5. We don't have to do a spread or anything like that. If it moves back to 12, they're worth $5. If they move back to 14, they're worth $3. Okay, 14, is that realistic? I mean, is that possible? Or are we just talking pie in the sky? Well, here's 14. 14, we almost triple our money, just shy of tripling our money. Okay. 13, we're a little better than a triple. 12, we're golden. So let's go do one of these. All right. Let's come take these 17s. We'll go for $1.30 here on the actual VIX, right? I'm going to buy the January 17 puts at $1.30. Just the normal monthlies, okay? And let's see. Let's go do 6 contracts here. We'll do 6. Actually, let's go with lucky number 7 again. We'll do 7 contracts, and so that'll be 910, right? So $910. So we've done 650 in XLU. We've put 770 in YY, and we've put 990 with the VIX. So that's going to leave us here with enough for about one more of these, these gambles here, right? Let me see exactly how much. I'm sorry, the quick math isn't happening in my head. All right, that leaves us with $670, right? So about a XLU-sized position that we can go and make. So, let's think. What is maybe the market not really, pricing, or, where are they maybe just a little, little absent, right? Here's the CSX. It's already bounced pretty big. Ah, man, that's kind of a tough one to want to go buy. But what about a return to the 200-day moving average, right? I mean, that wouldn't be uncommon to see. Little test back to the 200-day moving average. Would that pay us anything? We can pick up the 60, 62 and a halves for 40 cents and essentially make 250. But that's playing it all the way down below the 200-day moving average. That's playing a just total fall off the cliff. And yeah, market going to hell in a heartbeat here, right? That's what that would be playing. If we look right now, we have three positions. We have a VIX puts, YY calls, XLU puts. Basically, all of them are, hey, market bias to the upside. But let's throw one in where, you know what? If we have a scenario where lows don't hold, market tanks, bye-bye, here we go, bon voyage, where we can maybe take a little bit of advantage. What about a Micron? What about, obviously, CSX? Can we get something that's maybe had a little bit of extra bounce in whose price is, whose option prices are relatively cheap, and whose stock may really struggle if the market continues to pull on back, right? In this, I want to look for an expensive stock, something that's fundamentally expensive. A J&J, a Pepsi, a Triple M, right? CSX is a little more fundamentally cheap, right? A little more fundamentally cheap. But let's just go see what the Triple M options look like here. Put spread. If we come here to 185, 180, we can get there for about, what, $1.60, $1.70 to make 5. Doesn't quite make much sense, right? Not nearly as good as CSX. Well, let's just take a look at the overall market. Implied volatilities have come down today, right? I mean, and we don't really have to worry too much about implied volatilities when we're doing a spread. But, let's see. Are they paying anything? If we come down here to 260 and 259, we can get in here for what? 45, 15, 20, 25 cents. So we can get a 259, 260 for 25 cents. That's taking the market down to right here, right down to these lows. So if we are right, if it does go down there, I hate using right and wrong on these. If it does go down there, we're going to make, what, $1,800 on our $600, right? So we'll have a decent return there. What about something like the IWM? Let's go see what these are pricing out here down in the 140s. Obviously, our VIX wouldn't work if these worked, right? Yeah, we're getting a similar. We're getting 25 cents here in the 144, 143. Let's go back to the SPY. Let's come a little bit deeper here. Just want to see what they're paying here. Get under 20 cents. All right. Let's come in where we can get this kind of 25 cents here. And let's run with it. The 262s, they're flipping here in real time here. So 550, 575. All right. So we can get the 262, 263s for 25 cents. 262, 263s for 25 cents on the SPY January put spread. So if we do 25 of those, we have enough cash. So we'll do 25 of those here at 25 cents. All right? So that gives us our 4 positions. Gives us our 4 positions. Now, when I go and make this type of trade, I tend to completely ignore it. Absolutely, completely ignore it. You kind of have to. It's kind of like buying a position like IBM, where I start a position. And I say, I'm going to start a position at 140. I bought 20%. I can't sit here every day and go, well, it's up a little, it's down a little. What does that mean? What does this mean? And sit there and just drive myself insane with it. I've marked that I'm going to buy at different levels, and I have, and I'm at 65% of a position. Do I really care what it's doing right now? I don't. I'm in for long haul. I'm looking for another opportunity to add more. But I've decided I'm done buying on weakness. I've bought on weakness here. I've bought 4 different times. Now I'm going to look to add on strength. Okay. Is it going to make any sense for me to sit here and go, well, the volume was this, and it's doing this, and they did this, and they did that, and all of that? No. Right? They have the news. They overpaid for Red Hat earlier this week. We talked about it. And we even talked. IBM path of least resistance in the short run is probably down because investors are fearful that they're going to overpay. So, oh man, market's up big. IBM's down. How do I make it? No, right? I can't do that. I can't put myself in that position, right? Because, well, what if it bounces $10 in the next 2 weeks? Is something big and different? No, nothing's big and different there. And so with these, right, this isn't something where I can sit there and now go, well, okay, tomorrow the VIX does this. Tomorrow the VIX, it just went to 18. What does that mean? You know what? I have a little gain on my position. Do I take it? What do I do? Do I hold it? Well, my other one's down 50%. This one's up 100%. Do I just take a bolt and take that small gain? I'm not in there for that, right? I'm not buying these for that kind of psychological lunacy and that type of absolute torture that the market can put on. So when I buy these, I'm generally buying them and saying, look, I'm going to give it some time. Yeah, I'll wake up, see if something's different one day. Sure, maybe look at it. I'm not going to read much into it, right? Not going to read much into it. Those IWMs I mentioned that we talked about back here, and I mentioned again this morning, I took mine off way early. I watched it too close. Right? My AMDs, you could argue I took them off too early too. I took them off after earnings. But it's not something where you can really read much into it. It's also not something that should influence trades going forward. Meaning, just because you have this lotto, on the VIX doesn't mean you now look at everything and say, well, everything has to go up. Or you have this lotto on the downside with the SPY, say, well, everything's got to go down. No, these trades are set up. These positions, these kind of high reward, high risk plays, they're set up for anomalies. They're set up for big things to happen in the market. And we see them happen all the time, right? They're happening. We're doing them in places like YY, where the shorts are really entrenched. Right? Where any positive type of news could really help it to balloon. We're doing it on something like the XLU, where investors have rushed for safety, starting to assume that the Fed isn't going to continue to raise rates. Well, Fed continues to raise rates. XLU back down here in the 40s, upper 40s, yeah. What's not being priced into the market? Well, calm. Okay? The market's not pricing in a new bull market. after this correction. So we try to take advantage of that at the VIX. And if if the market goes to hell in a handbasket, now we've used this bounce to now set up a put spread down here, 262, 263. Market doesn't even have to hit a new low, and we score. So none of these positions are made because I think the market's coming down here, or I think the VIX is going to go do that, or I think why. I don't have a crystal ball. I don't have this predictive power. I don't have this power in the charts that says, man, this is going to happen in the future. No, these are set up with a little bit of money in each to be able to go ahead to say, look, these are things that could happen based on what's going on out there. And it wouldn't take much for each one of those to happen. And if it happens, home run, right? I've quantified my risk. I've said $3,000, right? You say, well, Jeff, why don't you run a challenge this way? Sometimes I think that'd be fun, right? And maybe one day we'll take a challenge and do it this way. But I don't have monster reward potential because I did mostly call spreads. So I can actually quantify my reward potential. And then with the VIX, you can quantify the reward potential on those puts because it's probably not going below 10. So that would be like best case scenario. So we can quantify our reward potential, but we have about $10,000 worth of reward potential here on the $3,000. Right? That's about what we have here in this scenario, if we're right on everything. So in a scenario like this, I go if I'm super lucky, $10,000. If I'm modestly lucky, about $6,000. So that's kind of how I've set it up. That's kind of how I'm looking at it. And as we go forward, we'll take a look at these, maybe peel a few things off here and there as things go. And then one thing we can do is if something goes dramatically against us, we can go and peel one leg of the spread off. If it gets down to be real cheap, we can peel a leg of that spread off and hold the other leg. Thanks for hopping on. I'll be back on here in about 2 minutes, and we'll talk about some of the signals in the market here today. And we'll talk to you then. Take care.